Welcome to Gold and Silver, Diversification in the Age of Uncertainty, featuring Wall Street Journal best-selling author Robert Wiedemer and your host, Mike Maroney.
Good afternoon. My name is Mike Maroney, and I am coming to you today from the Monex Precious Metals Studio. It's May 2nd, Tuesday, and we had an amazing opportunity today to have Bob Wiedemer, the author of both Bubble Economy, Aftershock, and then, of course, Aftershock Investor, do a speech for the sales force to really go over some of the key fundamentals and features of the market that really dictate price. And today, Bob also gave us a quick glimpse of a new index that he's putting together. It's called the Uncertainty Index, that will really give investors a under the hood view of the engines that move the overall markets and basically allow you maybe to get a little bit of lead time as far as your investments are concerned. But let's talk a little bit with Bob today about what we discussed as far as general concepts that exist in the marketplace and what could affect precious metals here in the near term. Bob, first of all, it's great to see you. Now, Bob, you're in Washington, so you really have your finger on the pulse. And obviously, the market's priced in tax reform, they priced in infrastructure spending, they priced in the replacement of Obamacare. And it seems like none of this has come to fruition, yet the stock market is still trading at extraordinarily high levels. What's your opinion on this?
Well, in Washington, the word is called spin.
Oh, yeah.
Yes, and they do a lot of spinning, and as we know, in the stock market and business reporting as well. Yeah, absolutely, Mike, you're right. So much of the rally in November and December after President Trump got elected was due to hope for tax cuts and infrastructure spending. But now, in fact, I was just on an interview on a major business channel, and one of the other people speaking with me indicated that tax cuts, they're not part of his plan anymore. He thinks the market's just going to go up even without tax cuts. He said the earnings or whatever have driven the current rally. Well, that's nonsense, because clearly back in November and December we didn't have earnings. We just had Trump's election and the hope for tax cuts, which I think are the biggest part and the most important part of President Trump's plan to invigorate the economy. That's clearly dragging on for a while. I mean, if they can't get the Obamacare repeal done, tax cuts are a lot harder. As I've said on television shows and elsewhere, you're going to have Democratic support for this to work. Ronald Reagan got Democratic support for his tax reform to work. I think they're going to have to do the same here, and I don't see the same ability that Ronald Reagan had to get it done this time. But we'll see. I think something will happen, but I think it's not going to happen quickly, and it may not be anything like what the market had anticipated in November or December. So some big changes, some big uncertainty at this point as to what really is going to get done and when.
Now, it's interesting because I think people thought that Donald Trump's political acumen was going to be tested, and he's a rookie, so things are a little bit tougher. But when you have all of the things lined up the way he did, you have the House, you have the Senate, you thought that the Republicans would put this thing together, but it seems as if that's not going to happen. Now, if the stock market is overvalued based on maybe pricing in all these things almost to perfection, and the bonds are definitely looking a little bit top heavy, doesn't it make sense in this type of environment for investors to look for key ways to diversify?
Yeah, I think so, because so many people are looking at the market right now and it looks good, but it's sort of scary. It's clearly highly valued. It's near valuations that we hit in the dot-com era, and we're seeing some dot-com type companies that have made no profits at all for years, but like Tesla is still highly valued more than General Motors. So people are worried. Do I jump in right now? And what I'd say is, most importantly, diversify. You're absolutely right, is you need to have not just stocks, not just bonds. Those are getting a little more correlated. Certainly stocks themselves are very correlated. Even around the world, if US stocks go up, European stocks go up. So I think some diversification now when we've got this tax cut uncertainty especially would be really important. Diversity into precious metals, gold, silver, because they're not correlated with stocks, and that's a good offset. So if you have stocks, I'm not saying run out and sell them, but add to that some diversity in what's clearly a highly valued stock market and clearly some uncertain times, because so much of our rally was based on tax cuts and maybe some infrastructure as well that may not happen this year, or we'll see even next. Even when it does, it could be an issue. And I might add one last thing. Remember, Congress is up for re-election next year, and if the Senate goes Democratic, it changes a lot for Trump, which, as you said, had really everything lined up for him with a fully Republican Congress. It may change.
Now, it's interesting because you had a statement about diversification, and I thought that was very pertinent as far as investors in general. What was it? It was, don't wait to diversify, diversify. Share it with us again.
Right. Well, for one thing, it's hard to time. When I say there's uncertainty, well, that means it's uncertain. It doesn't mean I know exactly when something may go wrong, right? Just like part of the reason you buy life insurance is you don't know exactly when bad things might happen to you. You can't just buy life insurance a week before you die and, oh, well, that way I saved all the premiums. You don't know when. So you need to diversify and then wait. It's hard, but especially in a time when we're very uncertain about when timing may happen, when timing of bad things may happen, we kind of know they will. Just like, death, we kind of know what will happen, and we do know. Don't like think about it, but we've got a market that's clearly highly valued. We know there's some problems out there. It's just a matter of uncertainty as to timing. So you're going to have to diversify and then wait, rather than waiting and diversifying at just the right time. Nobody knows just the right time, and there's really no need. Better just to diversify now and maybe stay diversified or get a little more diversified if uncertainty increases, but do it now. Diversify now and wait rather than wait and diversify.
Now, when you look at historic norms as far as pricing is concerned, what I found interesting today in your presentation, you were talking about the overall valuations as far as the GDP was concerned. But one of the things that popped up was how we suddenly went into a major sell-off in the dot-com, and you questioned the crowd and said, do you remember what caused that? And no one really had an answer to the question, where suddenly perception just changes. And based on the current valuations, it would make sense to diversify into undervalued assets like gold and silver.
In fact, counterintuitively, a time to diversify is when everybody's pretty giddy. Exactly my point was that in March of 2000, the dot-com bubble burst. In January, you would have no idea. Yeah, believe me, everybody kind of knew in their gut that, oh, this internet thing's probably gone a little far. Certainly, certain companies aren't going to succeed. Some will fail. But very few people knew when there's going to be a big correction or that it would be so big. I mean, it took in not just .com, but big companies like Microsoft, Cisco. So you're absolutely right. It's hard to get the timing. And to your point, and to people listening to this, think about it. What trigger did kick off the dot-com burst in March 2000? Ask your stockbroker, ask investment banking friends you know, ask any internet high-tech friends you know, and I bet you they won't know. And that's a key point. You don't always get a news trigger. It isn't that some bad event comes to the Fed or China that kicks off everything. Psychology can just change. Oh my God, we think it's too highly valued, and some sort of social viral interaction happens, and boom, it changes quickly.
It's interesting. I'm going to steal one of the lines from your book. I think Mark Twain said it when he was talking about bankruptcy. They asked him how he went bankrupt. He said very slowly and then suddenly. And that's how prices change as far as markets are concerned. So interestingly enough, we're talking about uncertainty. Obviously, the political situation here in the United States has a lot of uncertainty based on the fact that we haven't seen the overall efficiency that we would have expected from a president that has control of both the House and the Senate. And there's some things going on overseas. People are a little bit fearful of the inevitable result as far as what could happen in Germany with Merkel. And obviously this coming weekend we have the French elections with Le Pen. And in the original or the first runoff, she didn't do quite as well as expected. But if we're dealing with Brexit and add in Frexit, it could get a little bit crazy. What do you think about what's happening in Europe, and how do you see the outcome of those elections?
As we all know, predicting outcome to elections is a bad idea. Lately we've seen Brexit, we've seen Trump. And predicting the outcome of what exactly the markets will do is also uncertain, lots of uncertainty. I don't know exactly what's going to happen. What I can say is Europe is a wonderful source of uncertainties and problems. The problems aren't solved, just like us. They've kicked the debt problem down the road. They have problems with the euro. There's problems within the EU. There's still problems with Greece. At any time, things could happen. And I would just say, just keep Europe in mind as a general problem, but also flip to the other side. North Korea, which wasn't much of a problem, more kind of a nuisance or something for late night talk shows, has now become a real problem. When you've got a nation like that led by, a bit of a nutcase that has nuclear bombs and, longer range nuclear missiles that could ultimately become intercontinental missiles, that's a big issue. It's very destabilizing to where the world depends on for its growth, China. And it's very destabilizing, that whole region. It puts China under a lot of pressure. I don't think they really want to see North Korea with lots of nuclear missiles either. So there are a lot of destabilizing factors, and absolutely Europe is one of them. And I can't tell you whether it's going to be Le Pen or Merkel or back to Britain, where somebody says, oh, I thought the Brexit was a fake. Now we're all thinking it's for real, and the market goes down. It can happen. Europe is a hotbed of uncertainty, as is North Korea and other areas.
Now, it's interesting because a lot of people look at what's going on in North Korea, and I guess our president met with the Chinese president, and suddenly it seems as if his story's changed a bit as far as his perception of the North Korean leader. Now, a lot of the political pundits are saying maybe he's slow playing the situation and maybe getting ready for some sort of military action. But I don't think a lot of people realize what an industrial center South Korea actually is, and how that would affect the world economy in a way that is somewhat mind-boggling if we see some sort of action. So that's a much bigger problem than a lot of people are reading into it, wouldn't you say?
Yeah, you don't have to have a nuclear bomb to go off to cause economic issues and problems. Korea is a massive economy. It's not as big as China, but it's very important. One of the biggest economies in the world itself. So that's South Korea. China too. So again, just uncertainties and issues there because there already are some, and that's kind of the general rule here is there's already, like the internet bubble, sort of an, market's price for perfection when we all kind of know that's not going to happen. Markets ignoring the massive debt the government has and ignoring the massive money printing it's done. We all kind of know in our gut something's going to go wrong there. So it doesn't take a nuclear bomb by North Korea to kick off problems or concerns about China, which has its credit bubble, or other issues. It takes just more of a destabilizing moment before psychology can change quickly if anything starts to really go wrong in North Korea. And man, if there's one country I wouldn't want to count on knowing exactly what they're going to do, it's North Korea.
Yeah, it's pretty crazy over there. Now, the interesting thing when we think of geopolitical instability, suddenly we're not even talking about the Middle East here today. And
right.
Obviously we have the Syrian issue. A lot of people haven't talked about what's happening in Yemen and the revolution that's going on over there. Matter of fact, it came out, I think, yesterday how Al-Qaeda is actually fighting with the United States in Yemen, whereas in Syria we're fighting against them. We can't even figure out who Al-Qaeda and who ISIS is. I can't imagine what's going on. That whole situation could get even crazier. So with everything that's going on, your uncertainty index, I think, would be such an amazing tool for investors. But what other things are you looking at as far as this index is concerned?
Sure. So it looks at four factors, two of which are political. As you said, the international political, the domestic political, which we've talked about with Trump and tax cuts. But it looks at two economic factors. One of them is commodities. And that might seem strange because it seems like a narrow part of the broader investment market. But the reason I look at that is because China. China is the key to economic growth since the financial crisis. It's really been the growth engine of the world. If it slows down or it has a credit problem, and I think it will, fair amount of that growth was driven by a credit boom, it's not going to show up necessarily in Chinese economic statistics. They have a tendency, like any government, more so in China, to cover things up, problems especially. But the commodities prices are sort of a real indicator. If iron ore prices go down, copper prices go down, oil prices go down, that's an indicator that probably China's having trouble. Remember, not longer than about a year ago, January of 2016, the price of oil falling basically collapsed the market, went down to 15,700. That's almost 5,000 points below where it is today, and it was only 1,000 points above its peak in 2007, 10 years earlier. So the reason it went down so much wasn't so much oil and oil company earnings, but when oil price went down, everybody kind of knew that meant China might be slowing. And it's true. People know it, I know it. Commodities are just a great way to look at China and how it's doing. So that's the third factor, and again, one of two economic factors. The other economic factor is the stock market. Kind of goes without saying, that's a great way to try to get a feel for how the investment community is looking at the world, whether they're happy or sad, right? But it's not just a simple matter of looking at the stock market, whether it's high or low. It's also looking at, has it been increasing for a while? And longevity is first key. If it's been increasing for a week, I don't care. It doesn't affect the index as much. But if it's been increasing for a year, that's different. Or if it's been decreasing for a week or a year, that's also can talk about uncertainties. If it's very short durations, that's more uncertain. Second thing on a stock market, volatility, the VIX. If the volatility is high, that means that stock market's more uncertain. And then third, fundamentally, what we were talking about earlier, valuation. Valuation of the stock market is high. And right now, it could get higher. But to put it in perspective, as you said, I mentioned earlier that the value of the market right now is equivalent to about 130% of our GDP, our entire economic output for a year. Not too far away from 2000,
records, right?
Yeah, the records in the dot-com days. So those three factors, valuation, longevity of the increase, and volatility are what comprise that stock section. So it's commodities, stock, domestic political uncertainty, international political uncertainty.
I get it. I think it's interesting because when I've spoken with you in the past, you look at different things, and I think as an economist, you look at key things or variables that affect pricing. And I remember you talking about looking at the amount of electricity that China uses, and you can't fudge that factor. And then I remember you talking about driving around and looking about how many cranes are in any one given city to really get a feel for what's happening with the economy. Now, this Chinese situation, the investors in China were hurt somewhat in the real estate market. They've been a little bit fearful as far as the stock market, a lot of volatility. Supposedly a lot of money in Asia is moving into precious metals because they're not as trustworthy as Americans maybe as far as the overall currencies are concerned. And do you see that situation continuing as this whole economic situation really plays through in China?
Yeah, China's obviously a huge buyer of gold, the biggest buyer of gold, not just the government, but I mean the entire country, the people. So, all these uncertainties, whether it's Korea or the credit bubble or what we're tracking commodities, couldn't happen to a more, happier group of people to buy gold. They have a long history of buying gold, certainly more so than the US or even Europe. They like it. As you said, they don't trust stock markets as much for good reason. They don't trust their own government as much for some obvious reasons. So gold is a natural fit for the Chinese buyer who is seeing a lot of uncertainty around them. So I think that's only going to grow. Obviously, there's ups and downs, but fundamentally, that's got to be a driver for demand for gold going forward. Given their normal inclinations towards gold, I think will be amplified by all these sort of Chinese-centric uncertainties.
So it's interesting. The rest of the world seems to be aware a little bit more of the uncertainties that exist. We're somewhat anesthetized here in the United States, it seems. I'm not sure what specifically we're using, but you talked about debt today, and I found some interesting statistics when you made the presentation as far as debt to revenue and overall perception there. Talk a little bit about the debt to revenue and something that you've always done when we've made presentations. You'll ask the crowd, how high can we go? And then people say, well, we'll just print money. But then you always throw out, well, let's just eliminate taxes. Give us some insight on why you do that.
Sure, because I think people, in a sense, know more than they say. You said we're anesthetized. That's true. And I'd say we're also trying to fool ourselves. And that's why I try to shake them out of that, shake them out of their anesthesia, shake them out of trying to fool themselves that in some way we've got the problem solved. We've had a massively growing debt, but you don't have to worry about it because we can always print money. And again, let me point out how massive that is. And this should be a figure every investor should know. What's our government's debt to revenue ratio? Our revenues are our taxes, and of course our debt is our national debt, about 20 trillion. That ratio right now is around 6 to 1. Would you or anybody else lend to a company or an individual that had 6 times as much debt as they have an entire income. Remember, knowing that that person and that company has other expenses to pay than just you. That's the government. That's the situation we're in. Whenever I mention that, people, and I say the government still can borrow money, no problem though, unlike you or me or a company. And every time people go, the reason it can happen, I always ask, and they sort of go, it's because we can print money. And so what we believe now, how we're fooling ourselves, that printing money won't create inflation. And of course it will. And that's why I use the tax analogy. Because people who say, Bob, they've been saying that for years. We printed money, as you say, we quintupled the money supply. Yeah, we don't have a lot of inflation. We have some inflation, but not a lot, not like quintupled. And I always say, well, if you really think that, again, I think we're trying to fool ourselves, but you really think that, and you don't think printing money will create inflation, well, let's print a lot more of it. Let's get rid of taxes. They're a burden on us. They're a burden on everybody to pay taxes. If we didn't have to pay it, you know what? This economy would boom. Let's just print money, get rid of taxes. That's done. In fact, while you're at it, let's increase spending. Let's start building stuff. Let's start doing whatever we want. If we can print money and not get inflation, we got our problem solved. And people sort of know, you're right, Bob. Printing money will lead to inflation, and we all know it. It's true.
It's really interesting, and I think what we talked about is perception. And who knows what will change the overall situation as far as perception is concerned. So in review, we have domestic political situations developing. Unfortunately, the market has priced things in for perfection. We're not seeing that. Internationally, we have elections in Europe, we have uncertainty in the Middle East, and we've had a very interesting fellow running North Korea, causing some serious issues with some toys that are called intercontinental ballistic missiles, nuclear issues there. And obviously the debt situation that we've developed over the last 20 years isn't going away, it's only getting worse, and we're not fixing it. And that's the one thing. We're talking about infrastructure spending, trillions of dollars. We're not increasing revenue, we're only increasing debt. So one of these days, the reality sets in, perception changes, and that's why you shouldn't wait to buy, you should buy to wait. And that makes so much sense. I'm really glad you brought that up today. I think it made a lot of sense to all of the guys out there. And I think we're really looking forward to following this new index and really honing in on maybe individual opportunities to buy and sell. What do you think about silver, gold, platinum, and palladium right now? Do you have any specific opinions about the position of the markets?
Well, obviously, after the French, the original French elections came out, and it looked like Le Pen is likely to lose this coming runoff. And she was the anti-EU, anti-Euro candidate. The gold markets fell. The stock markets rose. They all felt everything's less uncertain. I think these are temporary moods. I think the fact is that the gold didn't fall that much. It had been on a rise. I think that fundamental rising uncertainty hasn't changed at all. I think that they got a little reprieve, but fundamentally there's just a lot of issues that are increasing the amount of risk in the markets, not decreasing. So no, and I think gold showed its strength. It didn't fall back below 1,000. Remember, there was people worried about that. We're way beyond that. So I think gold, again, day to day, that's your area, but I think in general right now, this year, the uncertainty is rising and the problems are rising. I think it's definitely the tailwinds are behind gold this year for all the reasons we just discussed.
Great. Now you love silver.
I do.
Because I know you like to get some for yourself sometimes. Has a little bit more volatility than gold. So some people look at silver as the speculative tool, not the investment opportunity. But we've had a nice little pullback in silver. But owning a little bit of silver and putting that away could really pay big dividends, don't you think, down the road?
I think silver will do very well down the road. In fact, for a lot of reasons, silver could do better down the road. My guess, it's more a guess, is that gold will do very well or best, but who knows? I could give you 10 reasons that silver could actually outpace gold. They're both going to do well. I like silver. I think it's good to diversify between the two. I always said diversification is important. But silver is also, it gives you the opportunity to trade, which I think is a little harder with gold. So you could use it two ways. Long-term hold, it's good stuff. And trading, if you're a trader, it's also, I think, an area to make some money in. That is a trading issue.
Fantastic. Well, We had an opportunity to meet with Bob today, and quite frankly, I think when you listen to Bob speak, you realize he's a man of reason. He uses economic theory, simplifies it so everybody can understand and really look at the things that are taking place and figure out why it might be a great time to diversify into precious metals. I think if you're interested in safety, if you're interested in protection, and you're also looking for profits, now may be one of the best times to own precious metals. But now is probably one of the greatest times to give us a call so we can get you out some of these special reports so you can look at all of the reasons that exist out there. And quite frankly, I think once you do, you'll see why so many people are investing in precious metals today. Give us a call. Bob, great seeing you again. And obviously, we'll be watching that index very closely. Thank you very much.
Thank you.